Good evening, everyone. Welcome to our University of Florida Alumni Homebuyer Workshop. My name is Jason Maida. Great to be with all of you this evening. I'll be your presenter and looking forward to kind of taking you on this journey of learning more about homeownership. Obviously, I appreciate you taking time out of your busy schedules to join us on a Wednesday evening. So this will be a very interactive class. So we promise to keep you very engaged in what we're talking about. Some really important topics to help you really prepare for your journey towards homeownership. So our discussion will run about an hour or so, but we'll weave within that discussion, your questions. You can use the Q&A in Zoom or the chat feature. I'll be monitoring both windows so we can answer some of those questions on air. We'll also carve out some time later on in our discussion for any kind of follow-up questions that you might have. So really excited to be a part of this with you. We had a lot of signups from our email campaign that went out. So a lot of you guys were pretty excited about this class. And this is a class that we bring out to the community 4 times a year. So we teach this class quarterly. We're really proud to be a partner with the University of Florida alumni. In fact, just a couple of weeks ago, we had one of your own fellow alumni buy their first house in the state of Florida. And it was just a really pleasure to take them on the journey. And that was actually someone that attended a class just like this just a year ago. So our goal hopefully is that you're going to get a lot of great takeaways from tonight's class to really inspire you to think, hey, I can really achieve home ownership. Whether that's this year as a goal or maybe in the next several years, we'd love to be a partner with you as you go through that experience of owning your own home. Well, I work for an organization called American Pacific Mortgage. We're the 9th largest lender in the country. Our team specifically focuses on local homebuyer education classes, and we do that through our university platform like the University of Florida alumni. So we're obviously, really invested in trying to coach up our community in homeownership so you can basically understand more about what this will look like, okay? So that's our goal in teaching classes like this. We'll have talking points tonight that look like a little bit like this. We'll spend about time looking at the housing market, what's happening from an interest rate perspective, which I obviously get a lot of questions around that. We'll also look at renting versus buying and kind of how does that compare from a budget perspective and really value add to my finances. We'll also look at credit, various loan programs that are available to you. We'll talk a little bit about savings for home ownership. That tends to be one of the biggest kind of challenges for some of our clients. We'll also look at first-time homebuyer programs, whether programs in the state of Florida or depending on where you're looking at buying. Could be in Texas or somewhere on the East Coast or even on the West Coast. There's a variety of different first-time buyer programs. We'll give you kind of a high-level look at some of those options. And then one of the more important features of our class is to go through the buying process. Where do I go? So if I'm interested in taking the next steps in homeownership, what should I be thinking about and what kind of actionable things should I be working on? And where does it go from here after class? So I'll walk you through the buying process and that'll kind of wrap us up for tonight's session. All right. Well, thank you again for coming on this journey here with us tonight. Again, our runtime will take us up to about the top of the hour, but we promise to give you a lot of great valuable tools here in our discussion. Well, the first thing I would like you guys to think about is when you're considering homeownership, think about some of the upside benefits of homeownership that you don't realize today as renters. So when I'm a homeowner, I get the ability to kind of control my outgoing budget because I know what my principal and interest payment is on my mortgage, my taxes, my insurance, right? As a renter, not so much because every year your landlord's probably going to increase the rent in more often than not. This is also an asset that should be working for you. This has the ability to be able to achieve, a higher value or appreciation. So as my home goes up in value, as I pay down my mortgage balance, I will create home equity for myself. And for most of us that are current homeowners, that is probably our number one asset that we have at our disposal. This home ownership can be really transformational for families, being able to create generational wealth for many families. And so those are things we want to think about with home ownership. We also want to think about tax benefits. When I think about mortgage interest and I can potentially tax that as a tax deductible item, that can help improve my financial position. Even when I make energy efficient upgrades to my home, that can also help to really preserve the tax amount that I have going out the door on an annual basis. So when you think about home ownership, it's really not fair to say, okay, I'm paying this amount in rent, so I probably should translate to that much in home ownership, because the reality is you're going to get a lot of great benefits in home ownership that you don't realize today as renters. So to help illustrate that point, I thought I would walk you through our rent versus buying calculator. And it's a tool that we have up on our website. in addition to other tools that we have available, like affordability calculators, just basic payment calculators. And for some of our existing homeowners, they can participate in a refinance calculator. But this is a great way to kind of help frame up homeownership and to kind of stack it side by side against your current situation. So I'm going to give you kind of just a what if example tonight. But as we share these tools with you tonight, like this calculator, you're going to get all this stuff back to you in email. So all of our slides from tonight, and we're recording tonight's class. So that'll be up on our YouTube channel tomorrow that you guys can kind of check back in some of your notes. So here's what this calculator looks like. Pretty simple, but we're gonna include a sales price of a projected home that we're gonna look at, which we're gonna say is 400,000. We assume a minimum down payment of 3%, which that is a minimum down payment for a conventional home loan product as a first-time buyer. That means I'm financing 97% of my purchase price. Average interest rate, which we'll talk more about in just a second. The term of my loan, which generally is always a 30-year fixed mortgage unless I decide to go and decrease the term of my loan. When I'm going to buy my house, if I'm going to put less than 20% down to buy my home, I probably have mortgage insurance. And mortgage insurance, we'll have a little section on that in tonight's class, but ultimately it comes into play when I put less than 20% down to buy my house. We have homeowners insurance. Taxes will vary based upon where I'm going to buy. Taxes might look different in, Gainesville than it might look in Austin, Texas, right? And so we want to make sure that we have a proper tax rate. If I'm buying a condo, maybe a townhouse, I might have HOA expenses that come with the community that I'm choosing to be a part of. And then this is where we have some pretty important inputs here. One is the tax bracket, which is what tax bracket am I at today? Because now we're going to start talking about tax savings. How much repair cost or maintenance cost do I have to put in my home, because that's going to be money out the door. How much is it going to cost me to sell my house one day? Because I'm going to gain all this equity appreciation over time. But when I sell my home, how much of that am I going to turn over to realtors and closing costs when I sell? And then we're going to factor in annual appreciation rates. All right, so that's all into the ingredients that make up my home ownership formula. Now on the rental side, it's a lot simpler because it's looking at your rent, which in this case is $2,000, renter's insurance, and then we're going to assume that our rent's going to go up about 3% every year. All right, so that's our buy side look, and that's our rent side look. And so what our calculator does is it creates this graph that says, hey, you know what, Jason, if I'm going to put in the 3% down payment and those investments to buy my house, what's the time that it's going to take me to break even on that investment if I was opposed or on the other side just paying my rent for the next 3 years? Well, I have a 3-year break even point with those investments to buy a $400,000 home. And that's a really short break even time. Generally, I would want clients to break even in 4 years or less, but we're talking 3 years or less, which is a really incredible opportunity. But it gets more exciting the longer I hold on to this home, because as my home goes up in value, remember, I'm seeing a higher value. I get appreciation because I'm paying down my, or more equity, I should say, as I'm paying down my mortgage. Now, as you can see, not only beyond 3 years, I'm now in the profit side, but look at 10 years. 10 years, I now have about $109,000 gain opportunity of owning my home versus renting. I can't tell you how many times clients that now are kind of considering home ownership go to me and say, Jason, gosh, I wish I would have bought in 2022 or 2023. I mean, there is a bit of a cost of waiting. Even though interest rates might not be ideal, there is some opportunity cost for sure. And so that's what I encourage our class to think about in terms of home ownership. Try to look beyond just hey, I'm paying $2,000 a month in rent, I got to pay $2,000 in mortgage, because it's probably not the case. This is going to be potentially an investment tool for you to, again, help create that transformational wealth for some home buyers. Now, every market's a little bit different. And so I think it's important to understand, what does the housing market look at in the respective area that you're considering. If you're looking in Florida, guess what? Florida is a buyer's market, so it's really appealing to buyers. We have seen, a kind of an oversaturation or just more supply for existing homes than other places in the country. Florida is one of 4 states that has the highest level of inventories, which includes Georgia, Texas, and believe it or not, Colorado is on that list too. So, buyers that want to get active in the Florida market, there's some really good opportunities there. What has kind of impacted the housing market in Florida? Well, what I've heard is insurance costs have gone up quite a bit. And so that is really impacting the ability to resell homes in an ample amount of time. If you look at the median days on market, this 69 days, that is probably double most of the markets that we're teaching classes in. So homes are definitely staying on the market. So if we're interested in participating in the housing market, what that means for us as buyers is we're probably going to be able to renegotiate a better price and potentially concessions by the seller. And what a concession means is the seller's either, giving up price, so they're reducing price, or they're contributing to our closing costs. In fact, the transaction I just mentioned to you, one of our clients that we helped in the community, is that they were able to get seller credits to help offset some of their expenses like closing costs. So that is the advantage you have as a buyer in a buyer's market, as opposed to the other way where it's a seller's market, and then we're, kind of in a difficult negotiating position. Now, as we look at the 2026 housing forecast, we're expecting still a bit of a reset. And I know we're halfway through the year, but we're still expecting a little bit of a reset this year. Things have kind of got a little bit off the tracks that we expected because of the conflict in the Middle East that we thought subsided, and now it's kind of coming back around. So it still does remain quite volatile and a little bit unpredictable with both the housing market and rates. But I will say the economy has been fairly resilient, and we'll talk more about that in just a second. Price growth is expected to be modest nationally. We're not going to see any big jumps in prices. Some stabilization, but also some markets seeing a little bit of a retraction in price. Florida, I think you could probably say with the amount of supply and demand, we could see a little bit of dip in price. And then the inventory and supply conditions are going to improve a bit. And you just heard me speak to that on the Florida market, but other markets are still seeing, some supply, maybe a little bit oversupply. But there's also markets like, let's say, California that doesn't have enough supply. And so builders, especially production builders, are trying to kind of close the gap to have more supply. And they're also offering incentives to buyers that choose to buy in those like new home communities. I do think in 2026, with us going kind of over the halfway point now, there is some opportunities in the market for financially ready buyers, because when there's volatility, there creates also opportunity. And so, that's why I think attending a class like this is really important. So you can really identify if there is a position for you to be in today's market. But it might not be today's market. It might be, 2 or 3 years out, depending on where your financial position is. Now, nationally in our housing market outlook, you can see, what we expected in 26 or this year, I should say, is for us to see rates go to the low sixes. That's still kind of a TBD situation, as opposed to where we kind of closed in 2025. You can see the existing home sales increasing from a value perspective. You see the median price going up just slightly, and then have, by the end of the year, inventory being up year over year. So that gives you a little bit of a look in what we're seeing at the housing market. Buyer behavior will also be dictated a bit by interest rates as well too. So, buyers love the rates that we saw in 2021, a little bit of 22. Obviously, that's changed dramatically since then. We remain in a very volatile market. The things that we're looking at, interest rates that are kind of moving the markets, is obviously what's happening with the conflict in the Middle East. We're also looking at inflation numbers that are coming in. Just yesterday, we got a really good inflation reading that it's called a CPI report, a consumer price index report, that came in a little bit softer than expected. So that pushed interest rates lower yesterday, which we really needed it, because once the Middle East conflict started to kind of bubble up again, interest rates kind of took a little bit of a hit there. But it's going to be a very volatile market. That's kind of just what we do, as we navigate through these markets with our clients. And there'll be little windows of opportunity for us to lock in the lowest possible rates. But I do think it's important to understand, as a future buyer, is interest rates change by the minute. So when the financial markets open up at 9 a.m. East Coast time, they close at 5 p.m. East Coast time. Interest rates can go up and down during that trading day, depending on what's happening, what economic news is coming out, who says what, who does what. All of those things can impact the level of interest rates. So it's important to work with a mortgage professional that really can help understand how to navigate the markets, because things are just not in a linear position with interest rates. We could see a 6.5% rate at the beginning of the day. It could be 6.75 by the end of the day. Now, interest rates are not the same for all buyers, and I think that's also important to understand, because credit score plays a role in your interest rate, the type of product you're going to select, how much you're going to finance, what your down payment position looks like. And some buyers, especially in today's market where rates are a little bit higher, ask a lot of questions around buying points, which a point is 1% of your loan amount. And usually that 1 point investment equates to about a 0.25% reduction in interest rate. I'm not a huge fan of buying points in today's market because the break-even point is usually about 3 to 4 years and or usually beyond 4 years. And most buyers are going to consider refinancing their homes, meaning refinancing to lower their rate in like 2 to 3 years. So it doesn't necessarily pencil to do something like that. The term of my loan can also change what my interest rate looks like. So if I go from a 30-year mortgage down to say a 15-year mortgage, that's probably going to reduce my rate upwards of 0.5%. But again, affordability is a challenge for many markets that we service across the country. So, most clients are trying to stretch out that 30-year mortgage as much as possible. 15-year will obviously make that substantially higher. As we meet with you for a consultation, and we'll talk more about this in tonight's class, we'll get a chance to sit down virtually and figure out the right design for you with your financing so we can build a plan that works for you and you can achieve homeownership affordably and in a fashion that's sustainable for you over time. Now, I want to include on our conversation around interest rates a discussion around APR because we get a lot of questions around this. It's called the annual percentage rate. What does that mean? What should I be looking for there? Well, APR is a calculation that includes the interest rate, but essentially points and fees and charges that are part of your financing. So it's essentially taking your closing costs and we put them as a percentage in the first 12 months of your loan. So what we want to be mindful as consumers is if there's a big margin between my interest rate, and you can see our example here of 6.13 versus our APR, if there's a big gap there, then we're going to see a situation where you're paying a lot of costs to achieve that level of interest rate. So let me give you a little bit of a glimpse into that. So if you look at lender A here has a rate of 6.13, well, lender B has the same rate, but what you're not seeing behind the scenes is that lender A is achieving that rate with a much lower fee structure. And in turn, they have a much lower APR. Whereas lender B is saying, hey, Jason, you're getting a 6.3 rate, but when you see your disclosures, like, wait a second, that's $4,700 higher in expenses, right? And so, that obviously has to register for us because at the end of the day, the rate is one function of our financing. It also includes the cost side of things. So lenders can get to any rate they want to essentially, but the important component is how much is it going to cost me to achieve that level of interest rate? So APR is somewhat of a unused calculation because the percentage doesn't really it's not as relevant, but it's really the dollar structure of fees that you're paying. So it's our job when we design financing for you is obviously to provide the lowest cost option for you, but also hit the mark when it comes to interest rate for you. Now, one of the things that goes into my interest rate selection is going to be also where my credit score stands. Now, every loan program does have a minimum credit score, and we've included some of those products on screen here so you can get a sense of like the minimum entry point. So usually the lowest credit score is about 580 to enter into financing. But we try to coach up our clients in credit. In fact, I was having a session with one of our clients in California today, trying to figure out ways to help them lift their credit score. So when we do a consultation with you, it's not just saying, here's your score, let's go figure it out. Let's kind of talk strategically about what things you can do to improve your credit score. Now, there are 3 different models to credit scoring. There's the auto financing model, credit card, and then mortgage. We're going to use the mortgage model when it comes to applying for your home financing. All right. Now, there are 3 different scores, right? Because there's 3 different credit agencies that report out data. That's TransUnion, Equifax, and Experian. We take the middle score of all 3 bureaus. So if my highest score is 760, let's say my middle score is 740, and then my lowest score is 720, we're going to use the 740 score when it comes to qualifying purposes. Now, if my partner wants to join me in the financing, but they have slightly lower credit scores, maybe their middle score is 700, well, we want to kind of think through that a little bit because that could impact the interest rate offering, mortgage insurance, maybe even the product offering. So those are conversations we also have with our clients during a consultation. I'm going to take you through the mortgage credit scoring model in just a minute, but I do want to pass along a matrix to you that shows you how long perceived negative items will stay with you on your credit report, whether that's a late payment, maybe it's a hard inquiry on your credit. This matrix kind of shows you how long those things will live on your credit file. Now, it will stay within or impacting your credit score in the most recent 12 to 24 months from the event. So if I had a late payment in, say, October of 25, well, we're still less than 12 months from that event. So it's probably impacting my credit score. But as I move further away from that item, I'm probably going to see my credit score start to improve. This is the FICO score calculation model for mortgage. And so I wanted to kind of take our class through this and kind of just walk you through each section. My hope is that you'll identify an area of opportunity in your own credit score, to be able to kind of see some opportunities for improvement. So the first area, which is not so much under our control, but it's length of credit. And so it's how long I've had my credit file open. So the more mature my credit file is, probably the higher my credit score is going to be. Next component is how much new credit I'm going to access, and that is controllable for us. We want to limit how many new accounts we're trying to open in a 6 to 12 month time period. We also want to avoid creditors that are doing hard inquiries on our credit. So we really want to avoid that. Now, there are rules in place for both mortgage and auto that allows you to apply with as many mortgage companies as you want in a 30-day window of time. It's the equivalent of one credit inquiry impact to your score. Now, in our process here with APM, we do things a little bit different. We actually start with a soft credit score. And the reason why we choose to do that is because a soft score does not impact your credit score at all. So we can get you pre-approved. We can develop your home buying game plan without impacting your credit score, so you can start your home search. We won't do a full inquiry until you're actually under contract with the seller. All right. 30% is amount owed on revolving credit. So we're talking about credit utilization, looking at your credit lines that are available, which are credit cards, versus your balances, right? And so there's an aggregate total that gets put into the calculation. Ideally, we want to have our balances at 10% or less of our credit limits. Now, I know it's the summertime, maybe we've booked or we're on some vacations and we've probably maybe charged up a little bit more on our credit cards. So let's say my balances are running at $8,000 right now and I have $10,000 in limits available to me. Well, now I'm at 80% utilization of credit, so I'm probably seeing some pullback in my credit score. My coaching opportunity for our client with that level of credit balances is to try to pay those balances to basically $1,000 or less, assuming they have $10,000 in credit limits. That'll help lift the credit score. That is really the optimal level, but that's probably easier said than done. So our first action item would be to say, hey, let's get those balances below $5,000. Now we're below 50% utilization. Now we're seeing a little bit of an uptick in my credit. Now, one way of managing down credit card debt is to try to get ahead of the reporting out to the credit agencies. And here's what I mean by that. If you look at one of your credit cards tonight, there's a billing statement date, which closes out your 30-day activity from the previous billing cycle. It's all your charges, all your payments, credits, maybe you returned an item to a store, whatever the case may be. If you can try to pay down those balances before the billing statement closes out, what you're going to do is you're going to beat the creditor to reporting out to the credit agencies, and therefore lowering that utilization. So if I take that $8,000 in balances and I drop it to $4,000 before the billing cycle closes, now I'm going to get that balance reporting out to the credit agencies, lift my credit score because I have lower utilization. If I wait till the due date's too late because it's already reported out to the credit agency. So paying it before the billing cycle date closes, you get ahead of that reporting out to the credit bureaus. Last section is pretty self-explanatory. That's the payment history. That's the heaviest weighting. If I've had any late payments, they're going to be rated as 30-day lates, 60-day lates, and then 90-plus day delinquencies. Just want to quickly highlight student loans because those are obviously part of what shows up in our credit reports. Just want to highlight for you that if you're on a savings plan for your student loans, we can use that payment right away. Where it gets a little bit more challenging is if you're not on a repayment program. Let's say you're trying to do an FHA loan, then we count 0.5% of the balances as your monthly payment. If it's a conventional loan, it's 1%. That's for a Fannie Mae conventional loan. So if you're in deferment or forbearance, we are going to have to use some type of minimum payment to qualify for your mortgage. It's easier when we are in an income-based repayment or just a repayment program together. But if you return to, let's say you're going back for your master's and you're not making payments and you still want to buy a home right now, then we would have to look at that default calculation. All right. I want to just open it up for questions. I know I've been kind of giving you a bunch of stuff here. Hopefully you're enjoying some of the information that you've received so far. We are going to talk about products in just a minute, but I just want to open it up to any questions that our audience has. And you can drop your questions in the chat or the Q&A, whatever's easier for you. But I just want to make sure to see if we have any questions so far. And well, of course, we'll carve out some time a little bit later too. All right, let's talk about loan programs. And I'm going to give you like kind of a 10,000 foot look at loan programs that are available to you. Some of this terminology you've already probably heard about, but I want to kind of piece it together for you. The first loan is a conventional home loan, which has a minimum down payment of 3% for a first-time buyer, up to the conforming loan limit, which today is 832,750. That loan limit gets updated every year around October, November-ish. And then what we'll do is we'll post new loan limits at that time. So it adjusts based upon cost of living across the market. But it is a national number. So whether I'm going to buy in Texas or Florida or Georgia, it's that conforming loan limit. Now, there are parts of the country that are called high balance areas that we can go higher. Like, let's say you wanted to buy a home in Arlington, Virginia, which is a higher cost of living. Well, that's a market you can finance up to $1.2 million. But anytime you go beyond that conforming loan limit, then that minimum down payment jumps from 3% to 5%. Next product is a federally insured loan. It's called the FHA product for the Federal Housing Administration. Minimum down payment of 3.5%. You can see the credit score requirement, but the loan limit does change by where I want to buy in the country. So it's based upon whatever county that I'm going to purchase in. Now, both the FHA loan and the loan below that is the USDA product are both government insured loans. They do have, unfortunately, residency requirements, so you have to be a permanent resident to access those programs. The conventional loan, you do not, so you can be a non-permanent resident and still get access to either a Fannie Mae or a Freddie Mac loan. Now, with the USDA loan, it's a zero down payment option, but you have to buy in rural markets, and you also have to meet minimum or maximum, I should say, income requirements by household size. And then the jumbo loan is going to be for clients that need to purchase beyond, say, the loan amount maximums for some of the agency products, but it's going to be coming with higher down payment requirements, higher credit score requirements. Most of our first-time buyers are probably not going to be in the jumbo product, but it's certainly an option that's on the table for you. Additionally, we have the VA home loan product for our veterans that have eligibility. It is a zero down payment option, a little bit more flexibility in the guidelines to encourage homeownership for our veterans. And then there really is no maximum loan amount for the VA product. Just as a kind of a side note, for those that might be interested, we also have a physician's home loan program that allows clients that are in residency or just starting a new practice or whatever, or just onboarded with a new corporation, to be able to have access to financing that might stretch beyond some of the regular guidelines that we see with, say, Fannie Mae or Freddie Mac. The big component is with the physician's loan, generally the conversation around student loans is going to look a little bit different than what I gave you with the guidelines earlier. So if you're interested in something like that, we can certainly talk offline on some of those product options. Also, if you're considering multi-unit properties, we don't generally highlight that in our product segment. But if you're looking at, say, a 2, 3, or maybe even a 4-unit property, with a conventional loan, you can buy a multi-unit property with 5% down for a conventional loan, 3.5% down for an FHA loan. I know I get some questions around, hey, I want to do the house hack kind of a thing, and I want to supplement my expenses for my home with like rental income. You can certainly do that. There's some different logistics with that, but it's certainly allowed for both FHA and conventional products. All right, now we want to talk a little bit about PMI or private mortgage insurance. And really quick before I dive into that, I know we're getting a few folks that are, because we're in multiple time zones. So just want to make sure that you guys know that I know if you joined a little bit late, I'm recording the class. So you're going to get the recorded version tomorrow up on our YouTube channel, and you're getting all the slides too. So we're just about halfway there, but anything that you missed, it'll be all recorded for us. So, and I also will take this question that came in, which is it generally worth waiting to save for 20% versus putting 3% down payment, or is this just on a case-by-case basis? So it really is on a case-by-case basis, because when we think about where we want to be in home ownership, we got to think about the end result of monthly payment and kind of how we get there. And there's different levers we can pull on, obviously lower interest rates, higher down payment, lower purchase price. Like all those are all different levers that we can pull on to help get to the end result of goal of monthly payment. So I think the misconception in home ownership is that I have to spend 20% down. And obviously, you guys are hearing from me tonight that you don't have to certainly do that. So I think that's an important conversation to have during a consultation, where we can kind of map out a plan and you can realize that, hey, I can still get to my monthly goal and I don't have to put 20%. Maybe it's 10%. And so I think that's just a conversation we have to have. Now, PMI, if we put less than 20% down, goes into that equation. And that's what we'll kind of explain now. And depending on the product, there's different kinds of mortgage insurance. So on a conventional loan, there's private mortgage insurance, which is PMI, and it's essentially insuring the lender against default. So if our client had a challenge, they couldn't make their payments, the mortgage insurance company would step in and protect the lender against default. Now, the difference with these two mortgage insurance options, conventional loan is PMI, so it's privately insured. FHA is government insured. It's insured by HUD. So there's different requirements and different factors. On a conventional loan, the PMI is based upon your credit score, how much you finance, and then what your down payment looks like. So it will vary. The higher I can get my credit score, the higher I increase my down payment, lesser cost I'm going to pay here. But it's really surprisingly not super expensive. The other feature with a conventional loan is that once you reach 2 years in that loan and you have 20 to 22% equity, you can apply to have the mortgage insurance canceled. And we provided an example of mortgage insurance down here at the bottom, so you can check that out. On the other side, FHA has two forms of mortgage insurance. There's MIP, which covers monthly mortgage insurance at a 0.55% factor. And then there's upfront mortgage insurance of 1.75%. That gets a one-time fee that gets added into your amount finance. But with FHA, you can't cancel mortgage insurance. The only way to get out of mortgage insurance if you refinance into more of a conventional product. And so as I look at the FHA product, when I'm counseling clients on options, it's probably going to be more of a short-term, maybe a 2 to 4 year strategy for me to get into homeownership, because the difference between conventional and FHA is around the qualifying parameters. FHA is a lot more flexible with credit scores, maybe debt to income ratio, which you'll learn about tonight, maybe past credit challenges. FHA will be far more lenient than we'll see on the conventional side, especially for at the lower down payment levels. Here's what that mortgage insurance cost looks like. You can see the mortgage insurance upfront there, and then the monthly mortgage insurance. So it will look different on the FHA side as opposed to conventional, but FHA is a great alternative, especially if we have some challenges to meeting some of the qualifying goals of homeownership. Now, one of the things we also look at is qualifying income. And so we look at what documentable income can we derive from our client's profile to help them qualify for their homeownership goals. Now, I did want to pass along some of the general documentation that we ask for in the buying process. So as you're thinking about going through our consultative process and helping you out in reaching these goals, these are some of the typical documents that we'll be requesting as it relates to income and a little bit of the asset side of things. Now, one of the things I like to cover in this section of our class is to go through different scenarios around qualifying income, because that kind of usually sparks a few questions from our audience. Now, in lending, we always have to verify a 2-year work/education history. So what that means is I don't have to be on the job for 2 years. I just have to show that I've been, say, doing my undergrad for the previous 2 years, or a combination of both with that and education. So if I graduated from UF like in the fall or something like that, and then I just started my job in January, I can account for my education to support my 2-year history to qualify for a mortgage. Because let's face it, I may have just started my job and I've only been on the job for 7 months, but I have a good income, I can qualify for a mortgage. As a lender, I just have to put together that 2-year history. Now, if I'm working in a position that's reliant upon commissions or bonuses, maybe I'm in an hourly position and I get overtime, that's a little bit different, because in that case, I have to show that I've been on my job 2 years, because an underwriter averages variable sources over a course of 2 years. So if I earned, $20,000 in bonus in 2025 and $15,000 in 24, we're going to average those 2 years to show more predictability with that bonus income. So that's just on variable sources of income. If you have a base salary, we can use that right away. Now, if I'm self-employed, I have to have a 2-year tax filing period. So I have to show that for example, right now, I have to show that I filed 25 and 24 taxes to use self-employment income. We also have scenarios where clients are working multiple jobs. So let's say I work for a healthcare provider and I work for 2 different providers, right? In that case, I have to show that I've been working for both employers simultaneously for 2 years in order to count that income in my qualifying. And another thing that kind of comes up in my conversations with clients, sometimes in the tech industry, we'll have restricted shares or RSUs that clients want to use to their qualifying of their income. So if I've been on my job 2 to 3 years, we can calculate in restricted shares. So for example, let's say I work for Google and I've been at Google for 4 years and I get a good amount of restricted shares. As long as I can see a 3-year vesting period on those RSUs, those can be potentially added into income calculations. Last thing I wanted to point out to you that we get some questions on is if I have a partner that is contributing to my household income, helping with the rent or the expected mortgage payment, I can't use their income to help me qualify unless they're going to be part of the loan application. So that's the only way we can introduce that income. And I also want to kind of add on to that. If I have a rental income source today, let's say my roommate is providing $500 towards my expenses today, I can't count that into the qualifying unless, let's say I'm going to buy a multifamily property and that person's going to sign a lease agreement with me. All right. Well, kind of staying within the same thread of income, I want to kind of talk a little bit about income versus expenses. And you heard me kind of allude to this calculation. It's called debt to income ratio, which is essentially looking at your pre-tax income versus your monthly expenses that you have today, but your projected expenses are what we're going to have as your home ownership setup looks like. So we're going to look at the principal and interest of my mortgage, what my property taxes might be, homeowners insurance, mortgage insurance, of course, if I'm putting less than 20% down or I'm doing an FHA loan, if I'm buying into a condo or townhouse community, or maybe it's a housing community that just has an HOA, that gets factored into your payment. And then, of course, your existing bills, things like credit cards, student loans, auto payments, that stuff. And we take those expenses and then we divide it by your pre-tax income. So we put an example here on screen with someone that's making $8,500 a month. So the debt to income ratio, if they have $3,000 expenses, means that 35.3% of their pre-tax income is going out to those expenses. Now, from a qualifying perspective, the maximum that percentage can be is 45 to 50%. That's on the high end. I get questions around, hey, Jason, what should it be? What's my comfort zone? I would say in the hundreds of clients that I counsel with throughout the country, generally when we're keeping those expenses below 36%, that seems to be like the comfort zone. But everybody has kind of a different tolerance level when it comes to expenses and kind of where they want to be. I was working with a client just before class and they were like, hey, I don't want to be any higher than 20%. And that's totally fine. But some higher cost of living markets will have to lend to like more higher debt to income ratios. But this is just more of a guideline from a qualifying perspective. It's not necessarily an indicator for affordability. That's one of the conversations we're going to have as we build your plan. Like, what does that payment look like? How does it feel? Is it sustainable for me to pay X amount of dollars? Last input that goes into building a home buying plan is going to be what my savings look like for home ownership. Can I reach that down payment goal of 20%, or am I at like a 3% down payment? Now we're going to talk about first-time buyer programs after this slide, but I just wanted to kind of share with you some of the documentation that we generally ask for, because in the process of buying a house, we have to validate where your assets are coming from. Now, cash cannot be used in a home purchase. We have to verify a 60-day seasoning period on all assets that are used. That includes checking and savings accounts, 401ks, 403bs, brokerage accounts. Those can all be used. You start dipping into investment accounts, I'd encourage you to talk to your tax or your financial advisor. And then gift funds can also be used. And that's where a family member is contributing to your home buying plan. They don't have to have their funds seasoned. We just have to paper trail kind of where they're coming from. And then there's a gift letter that they would complete. Now, when I think about challenges around home ownership, budget is obviously one of them because maybe I'm taking a higher monthly payment that I'm going to be taking on in my plan. But savings is probably the biggest one that kind of jumps out at us. And so what I coach clients through is like a savings plans for home ownership, because maybe I just started my job this year and maybe I just don't have the reserves built up yet, but I'm making good money and I can pay more than what I'm renting at right now. So in a scenario like that, I would encourage a client that if they're paying, say, $1,500 a month in rent, but we've built a home buying plan with a $3,000 budget, what I would encourage them to do is start making mortgage payments, or sorry, making rent payments like you're paying that $3,000 mortgage payment. So what I mean by that is every month on the first, I pay that $1,500 to my landlord, but I also create that surplus that I think I can build in my home buying plan. And I position another $1,500 in my savings account every month without fail. It's kind of a rhythm of saving every month. And by the end of 6 months, I have $9,000 built up in there. By the end of the year, I have $18,000, not including if I get really smart with the investment, is I take on a high yield savings account where I'm getting 2 to 3% interest every year. And now that $18,000 just tacked on another $540 in interest. So there are ways to kind of create that discipline for yourself in savings. I know it's easier said than done, but that's a great simple approach to help kind of building up the nest egg, if you will, when it comes to the assets needed to purchase your home. Now, first-time buyer programs can also close the gap for us in what we need to get to. Whether we're in the state of Florida, Colorado, Virginia, wherever in the country, there are first-time buyer agencies. They're usually called housing finance agencies that are designed to support low to moderate income households. Each state has a different definition of what that threshold looks like. If you're in California, moderate income is considered 150%, but maybe in Texas, it's 120%. And so it varies, but generally there are support mechanisms for low to moderate income buyers. So in Florida, HFA, there's the $10,000 assistance program with deferred payment that we can kind of tap into. Our homeownership loan program, that could be an option with a forgivable assistance option up to 15 years. There's a 3, 4, and 5% down option. I'm kind of giving you a bunch of different tools. These tools could be, standalone products, or they can be coupled with each other. But there's a lot of great resources that are out there. Even the Hometown Heroes program will allow you to get some discounts for, first responders, educators, folks in the childcare industry. So, there's a lot of great resources out there. And so I think going back to, the question we had about, saving for 20%, everybody would like to do that. And I think that's a great goal to have, but not only are the minimum down payments a lot lower, so hopefully that makes it more attractive to future first-time buyers, but there's also great resources that you can tap into and really close that gap for where you are today versus where you need to reach to with your home buying goals. We also have within APM our Pathway DPA program. It'll provide anywhere between 3.5% to 5% in assistance. It only works with an FHA loan, but for example, if we compare that with, say, the Florida HFA program, that Florida program has income limits. The Pathway DPA program does not. And within APM, we also have a program designed to support low-income buyers. So if you make less than 80% of the median income on a 3% down conventional loan, if you contribute 1% of your purchase price, APM will match with an additional 2% in a gift or grant that will help make up your 3% down payment. So there's some stipulations around that, but that's another great option for those of our clients that are less than 80% of the median income. All right, so that's a little bit of a look at some of first-time buyer programs. You may not be looking in the state of Florida, and that's totally okay. If you have questions on other states or want to just kind of talk offline, just let me know and we'll get connected. I'll kind of share with you how to do that in just a bit. I did want to cover closing costs in our discussion because when we think about savings for homeownership, I mentioned a little bit about down payment, but there's also other expenses that go into completing your home buying plan or closing. So what are closing costs? Well, closing costs include things like lender fees, some of the title fees or attorney fees, just general closing fees in your respective community that you're going to be purchasing in. There's also what we call prepaid items that are involved in a home purchase, which would be things like property taxes, prepaying your homeowner's insurance, daily interest charges that all go into the equation. Closing costs from a terminology perspective will usually include everything I just shared with you. So all of those items. And the prepaids are kind of the sub section of the closing costs. It's safe to say that you should estimate around 2 to 3% of your sales price for closing costs. And then your prepaid items will vary based upon where you're going to buy in the country, what those tax rates look like for you, how much your insurance is going to be for your property, when you're closing on your home loan. So those all go into the prepaid items. When we meet with our clients for their consultation and design their pre-approval, we're going to put some general estimates together for those closing costs and prepaid items. But it does depend on what you negotiate with a seller when it comes to closing costs. As I mentioned earlier, when we were talking about the housing market, like closing costs may look one way here in this particular state. It may look completely different somewhere else because of kind of what, where that market is at, whether it's a seller's or a buyer's market. You may be able to get concessions from the seller to offset some of those expenses that you have in your home purchase. Once you're under contract, which basically means once you have an accepted offer with the seller, and we're going to detail out all of the line items that are involved in a home purchase. And so we'll talk about more about our follow-up consultation in just a bit. But the ways you can lower closing costs is, like I just mentioned, to help negotiate down those costs with the seller. So maybe they're pitching more on the closing costs versus you are. Negotiating seller credits, whether that's at the start of your contract based upon where you've landed with purchase price, or maybe after you've done inspections. And then, of course, taking advantage of maybe some of the first-time buyer resources that can provide closing cost assistance. So those are all ways that you can help kind of mitigate some of the out-of-pocket expense when it comes to those closing costs and prepaid items. Now, we're going to take you through the buying process, and we're almost to the finish line in tonight's class, but stick around for this part because I think it's really important to help illustrate like where do we go here from after attending class, because hopefully we've sparked some ideas, some thoughts of like, hey, I really want to get to that goal at some point in time. And so I'd love to be able to share with you like where does it go from here. Well, after tonight's class, you'll have an opportunity to connect with me for your free consultation. That's where we do a 30-minute kind of deep dive into homeownership and seeing what your budget needs to look like, maybe a credit plan for you, a savings plan, and figure out the right product for you to reach your home buying goals. That consultation is the design of your home buying plan. And then the output is a pre-approval. Doesn't mean you have to run out and buy a house this weekend, maybe even not this year, maybe it's a couple of years from now, but at least you have a baseline for what eligibility looks like. Now, generally speaking, the pre-approval is good for 60 days, but that can be recertified at any time. We have some clients that, have gotten pre-approved and found a home in 2 weeks. Sometimes it's 2 or 3 years. So we just want to make sure that we have the roadmap built for you as part of our free consultation service. Now, when you're ready to go, step 2 is the next milestone in the process. That's the house hunting phase. That can be really short. It could be really long. If you want to be in a certain community, maybe a certain school district for your kids, maybe you have a certain lifestyle of community. Maybe you really want to be in this one condo community because it's walkable for to work or whatever, or you like the park system, whatever it might be, right? The house hunting phase could take the longest for you. Once you're pre-approved, you do move into that step 2. And we would encourage you, after you've kind of started figuring out where you want to be with online searches, to connect with a local realtor. We have preferred realtors that we work with all across the country that are experts in supporting first-time buyers on their journey. So when the time is right, if you want an introduction, we're more than happy to make that connection for you. So we're moving down the tracks here. Let's say you've identified the home that you really like, and you've positioned yourself to make an offer on the house. Your realtor would help to build that offer for you, to present the offer to the selling agent. And if that offer gets accepted, now we're going to move to the next milestone. That's called step 3. And we call it entering escrow. It has different terminology in different parts of the country. But at the end of the day, it basically means that you and the seller, I should say, have come to an agreement on a price and terms and conditions of that offer. And the day that happens, you're going to get a call from me saying, hey, congratulations, you did it. Your offer's been accepted. Let's talk a little bit about next steps, and let's get you on the calendar for your follow-up video session so we can go through all the closing costs, the prepaid items, the design of your financing, monthly payment, and let's talk more about your interest rate locking strategy. Because again, remember, interest rates change by the minute. So we want to make sure that we can seize any opportunity that presents itself, especially while you're in escrow. In the terms of that contract, it's going to indicate really important timelines, like when you're going to close escrow. Most communities across the country, your escrow is going to close in 30 days, but sometimes it can be a little bit shorter. The quickest, I should say, closing time is usually about 14 days. Now, as we move through step 3, you're going to start seeing some action items, like you're going to be making a deposit on your house. And that deposit is called an earnest money deposit that counts towards your total out-of-pocket expense. It's usually 1 to 2% of your sales price. It does differentiate in different parts of the country, but I would say 1 to 2% is probably a good baseline number. And it does, again, count towards your total out-of-pocket expense. Now, depending on the design of your contract, in most parts of the country, there is some variation of a contingency that allows you to do some research on your property before you're kind of all in this purchase. And that contingency includes getting the house appraised to make sure the value in the community supports the purchase price that you're buying at, getting your loan approved to make sure that everything meets all the criteria for your loan, and getting inspections done. And that could be a whole variety of different inspections, whether that's a home inspection, roof, foundational inspection, maybe getting the pool checked out, whatever the case may be. That will all happen in the contingency period. It depends on the state that you're in. Some contingencies can be as short as 7 days. Sometimes it can be as long as 30 days. But it's giving you an added layer of protection as a buyer that you can kind of do your research and feel confident that I'm not going to lose my deposit. Now, step 4 is going to be the processing and the underwriting of the loan. We're going to get everything structured in your loan to go to the underwriting team. Also, again, we're looking at the rate position in the marketplace, trying to look to lock the rate. We're starting to have conversations around that, especially coming out of your follow-up consultation. As we move through these different milestones, you're going to be getting disclosures sent to you that highlight everything that's part of your financing, interest rate, payment, out-of-pocket expense. So there's a lot of clarity around that. As we continue to move through the process, now we're starting to get to the finalization of everything. Step 5, you've had your underwriting approval issued from the underwriter. There'll probably be some conditions that you're going to be assisting us with. And then we're also getting to a stage where we're going to issue the final closing disclosure to you, which essentially gives you a 3-day cooling off period before we get to the final stage in the process, which is step 6. It also has probably brought you to the end of your contingency period. So if you're comfortable with the outcome of your inspection reports, and of course we have your loan and your appraisal done, then you're going to give the realtor the okay on your contingency. And that tells the seller that, hey, we're good to go. Let's get this to the finish line. And that is step 6. That's the closing of the loan. That is one milestone that you have to be in person for. You have to meet with either an attorney or an escrow officer or a public notary to sign your final loan documents. Depending on the state, like in Florida, the signing, the distribution of funds from us and your funds coming to closing all happen the same day, and everything closes that same day. So that's called a table funding state. But let's say you're in a different state. Sometimes it could be a 24-hour period delay before we close the transaction. But everything gets recorded with the local county recorder's office. They record a grant deed to transfer ownership and then the deed for the mortgage. And once those confirmations are completed, now you're the new homeowner. And that's a huge day of celebration. In fact, after tonight's class, I got to go call a couple of our newest home buyers that are getting the keys to their homes this evening. So really cool stuff. And it is exciting. It's a day of celebration. And I just always tell our clients, like, our relationship doesn't end here because we want to stay connected with you. And we've done that through our aftercare program to keep you top of mind of what's happening in the market, whether that's seeing your equity position in your home through our HomeBot system, tracking interest rates on our dashboard for maybe refinance opportunities, or just maybe just checking in with you and see how you're doing financially. So we want to make sure that it's not a transaction for us with our clients. It truly is a long-standing relationship. Well, as we're getting towards the end of class, I just wanted to share with you how you can get started in the process and go through your own consultation. It's a free service, again, that we provide, and we've kind of tried to make it as simple as possible. It's a really easy 3-step process. You do an online application, you upload some of the required documents. Again, we're only doing a soft credit check, so you don't have to worry about your score being impacted. And then you'll use our scheduling system to book your consultation. And that's a 30-minute virtual session. So we'll do it on Zoom so I can screen share just different tables and different credit information that I can share with you, so we can really design a really comprehensive plan for you. Now, after tonight's class, you may have some follow-up questions, and maybe you just like to do it in more of a one-on-one setting. Feel free to schedule an introductory phone call with us. That's always a great kind of next step after class. So if you just want to learn more about a particular topic or process, or just have a scenario question, feel free to schedule that with us. And here's what our consultation looks like. Very comprehensive. I do think this is a differentiator from what most lenders do. I get that question a lot. What makes us different? It's really a high touch experience. It's really going deeper into really all the important elements that make up homeownership. We consider ourselves the leader in homebuyer education. That's why we want to kind of lead with value in an educational format like this. One other thing I want to point out to you, we try to lean into technology too. So whether that's mobile or some of our AI features to help support you better, it does not replace the high touch experience, the human element, if you will, of home ownership. So we want to make sure that we're always here, whether that's having a quick call to kind of talk through something you have some concerns over, or a text message. We want to make sure that we're always interconnected with you in our process. One of the things I wanted to point out to you, part of our alumni partnership with UF is we also discount services. So not only do you have access to our classes quarterly, but we discount our closing costs and really try to bring a competitive financing option to you. So our goal is to create the most affordable option for you in our financing tools. We also have other partnerships across the country that have very similar benefits in workshop classes like this. So, if you've enjoyed tonight's class, encourage you to share this with friends, family, and coworkers. We love just educating our community on homeownership. So if you found some value in this class, feel free to either send them along the YouTube link from tonight's class, or they can attend over our upcoming live classes. So we'll have the pleasure of supporting over 10,000 future homeowners in educational classes this year. Here's all my contact information. So if you want to reach out to me, feel free to do so. And, of course, on our socials, you can kind of check out what our community says about us, whether it's in Google reviews or Reddit communities across the country. We love what our community says about us. So, with that being said, I want to kind of bring us to a close for tonight's class. But before we do so, I want to take any questions that you have. I know we got a few minutes before we hit the top of the hour, and I know I'm probably holding some of you back before dinner, or maybe I'm right in the middle of dinner. So, but I want to make sure I can provide as much information to you guys. So, any questions from our class? Okay. I'll give it just another minute in case anybody's typing away over there. Um, and again, for those of us that you're very welcome. For those of us that were joined class a little bit late, no big deal. I recorded all of tonight's class, so that'll be up on our YouTube channel. And then we also will send back out those slides to you. The questions just dropped in, so let's go in. Let me go. And thanks for the thank you messages to you guys. I appreciate that too. Do new homes sell in? Do new homes sell with VA loans or only older homes? No, you can do a VA loan with new construction too. So you can buy new construction or resell homes with VA. Yeah, absolutely. Can you talk about the selling? Can you talk about selling a home and then buying timelines, etc.? So if I'm selling a home and then looking to buy something else, so yeah, I mean, I think selling the home is kind of the what if we have to see where it's priced and how long it's going to take to sell. On the buy side, as we're providing the financing, if you're going to be using the equity that you have in that home to transfer to the new purchase, generally you're going to be making that new offer as a contingent offer upon the sale of your home. And so when I meet with you for your consultation, we're going to do a what if scenario to say, okay, hey, I'm just going to make up some numbers. Let's say I'm going to buy a $400,000 house and I'm going to get $80,000 in net proceeds from the sale of my home. And I want to put that all towards my house. So I'm going to put 20% down. We would build that all into a what if scenario. And we would build a pre-approval that says, okay, if I sell my house here, I qualify for this house, so I can present an offer to a seller subject to the sale of my home. Hopefully that's what you're looking for in that question. Let me know if I need to expand on that. Is it good to wait if you don't have the down payment? Um, so, I think that's an important conversation to have during a consultation with us because, you know, the reason why I think a consultation is important is because, yeah, we might not have enough funds at our disposal today. So, yeah, maybe we need to wait. But what can come out of the consultation is a savings plan where we can say, okay, this is my goal. I want to get to a $300,000 condo price in Gainesville. That's where I'm targeting. And I may only have $3,000 right now. But how do we build our plan up so maybe we get to $10,000 and we have enough money and maybe we can leverage some assistance programs? I think those are the conversations that we have during consultations. I think that's important that our class knows that. Like this isn't our goal is not to say let's go out and buy a house in 2 weeks. It's to probably build a plan towards home ownership. Most of our clients that attend classes are probably not buying homes for a year or two down the road. Right. Another question was with the property tax implications that loom in Florida, is it best to get a house now before 2027? Um, that's TBD. I think there's a lot of things up in the air, not just in Florida, but all across the country. I mean, I think in different markets. You know, whatever happens with on the tax side of things, and I need to probably educate myself a little bit more. Um, I think there are areas of opportunity in home ownership, just like I mentioned earlier. If you're in a good financial position, um, there probably is some opportunity cost in waiting. Because interest rates, even though they're not at like ridiculously high levels, they're still at elevated levels. And I think that does push some buyers to the sidelines. And so if I'm looking to buy in a market like, let's say, Florida, well, right now I have sellers that really want to entertain my offer. And if I can get into a cheaper price today, I'm probably going to have an opportunity to refinance down the road. So it might not be the perfect storm of the lowest rate and the lowest price, but I probably have a better negotiating position because when the market flips, and let's say in Florida and things change and there's more people in the market and supply is dwindled a little bit, guess what happens? Prices start to go up, more competition's higher, all that stuff. So I think there are some opportunities in today's market. Okay. You guys saved all your questions to the end. I love it. Okay, let me see if I missed any. I got one more that popped in here. Did I? Okay, I got that. I don't think I missed anybody. I think Ken will tell me if I missed anybody who's managing some of the questions behind the scenes. Um, okay, cool, cool. Anything else out there that you guys have questions on? I want to make sure. Ken, I didn't miss anything, did I? I just want to make sure I wasn't scrolling through here. Okay, I think. Oh, we got one. Okay, nope, got that. Okay. All right, everyone. And thank you for that message. I appreciate that. All right. Well, I hope you guys have a wonderful night. Depending on what time zone you're in, it's either dinner time, quitting time, or potentially dinner time in about an hour. So thank you so much for being a part of tonight's class. Again, we'll get all these tools out to you. And I do hope I get a chance to connect with you to help build your plan and help you achieve your goals in homeownership. Have a great night.